All right, we are back with our call of the day. We're talking Apple. Bernstein upping its price target to $195 from $175, saying it's cautious on the stock into earnings next week, but see some area of potential upside. Their rating remains market perform. Shares up 50% this year. The entire committee owns it. Kerry, I'm going to start with you. You actually trimmed some Apple a few weeks ago.
Well, we trimmed a little Apple about 6 weeks ago, and we thought that it was getting a little pricey. Of course, it's gotten pricier, and anyone who's cut back on their Apple over the last year has made a mistake. So what do we think here? I mean, the market considers Apple both a defensive stock and an aggressive stock. You want to play growth, you play Apple. You want to play value or something, like a bank in defensive, you play Apple. So it's really hard in this type of market to bet against it. On the other hand, there's almost nobody who's overweight Apple. So we own it, but we're underweight. I mean, to be overweight Apple and Microsoft, you're going to have 15% of your portfolio in a couple of names. So it's hard to be overweight, and it's got the problem that every global company has. It's consumer spending in China, consumer spending everywhere. Phones are expensive. They're discretionary. On the other hand, people choose the discretionary money that they prefer to buy an iPhone than almost anything else. So it's really hard to bet against it and think that the quarter won't be good. But on the other hand, it's not a cheap stock. Anything over 30 times earnings in this market where the growth is not exceeding that level by any means. It's the biggest company in the world.
Okay. So Kerry's underweight. She's worried about valuation. Jim, you own it as well. Where are you at?
Yeah, I have about a 5% weighting in my portfolio, Frank, which is versus about 7% in the S&P 500. I'm underweight as well. I'm not going to sell shares here simply because of the technical flows that come into the market. If it goes into passive indexes, that's going to go right to Apple. Apple buys back shares, et cetera, et cetera. But by the same token, I'm comfortable being underweight and being overweight in other non-tech oriented portions of the market. I think the cross current here is people look at the last 5 years of returns, annualizing 33%. Versus 12% for the S&P 500, and they think that's going to continue for the next 5 years. I kind of doubt that. I mean, give me 1 second.
I agree with that.
Just give me 1 second. The law of large numbers kind of says it's not going to happen. The analyst community thinks the 5-year projection of earnings growth is 10%, and you're paying 30 times multiple. It's a PEG ratio of 3. I'm not saying sell Apple, but I just don't think this is the market leader. Sorry, Josh.
No, I was going to agree with you. You can like the stock, but not love the current setup. Look at Microsoft, had a great quarter and reported, and the stock immediately erased $3-4. You could definitely see something similar with Apple. They report a great quarter. They have good guidance. Everyone likes what they had to say. But look at the run up into that. So you can hold those two opposing thoughts in your head at the same time. Technically on Apple, resistance all year had been 179, 180. She broke out of that range. That would serve as the new support in my mind. So if you think like maybe there's 10, 15 $15 in risk down in Apple, I don't know how quickly it can add $10 or $15 to the upside. So I don't love the setup for new money here either.
Siege, last word.
Think about it. It's too expensive to be overweight. It's too well run to be underweight. We're neutral, but think neutral to the Russell 1000 growth in our growth portfolio is 13%.
Okay.
That is so significant, and that's what endorses Jim's point. If you have those flows, it's going to continue to head higher. So I don't want to be either side of that.